Hey everyone, welcome back to Pete's Investing Updates. In this strategy edition, we'll be talking about the simple trading strategy using the CCI crossing over the zero line versus some Heiken Ashi variations in terms of their strategy. But first, as always, don't forget to refer to our channel playlists, and that's where we review our indices each week, as well as some sample blue chip shares we follow, but also our strategies. And in this video goes into the strategies playlist. That's where we discuss some simple trading strategies, the average down process, and some money management ideas. As always, we're not offering financial advice here. We're just simply using this as an educational series for your benefit. A couple of things to consider. We track and trade on a daily chart since we want to backtest and see results of trades back during the GFC as well as COVID. We also track and backtest revenue over drawdown requirements as a percentage. This is to optimize our returns with less exposure. I'll explain what that drawdown means. We include brokerage in our backtesting. I use $8 per transaction per trade to buy and sell. And that should be factored in as part of your testing for any brokerage costs that you may be using, whether it's 10, 20, whatever the brokerage costs are. And lastly, I use $2,000 per trade whenever we buy and sell. And this is to show the revenue relevant to the investment made. Obviously, the higher the revenue you put in there or the higher the trade you put in, the greater the return. But also be aware this will also increase your drawdown, so ensure you factor that into your money management strategy. Okay, let's get started. First, we'll jump into our table of results. Now, I'm comparing 4 programs here, and it's going to be quite heavy in terms of detail. I'm not going to show you every chart here. I'm going to show you basically the CBA chart, the revenue or profitability drawn from that versus the drawdown requirement. This is the entry and exit we use for this first program. This is the program we choose to use, as in shown by this percentage result down here for the percentage profit over drawdown. And this is the average down entry we make for each average down. Then I'll show you a chart for Telefonica. So let's just briefly go through this, and feel free to pause the video and digest some of these numbers in terms of the strategies. But in terms of program 1, it's generated $21,600 over the period since the start of 2007, and the highest drawdown it's drawn was 11,491 at any one point. That's 189%. So profit over drawdown. It equates to about $124 a month. That's our preferred strategy. Program 2, if you look at those numbers here, Telefonica has drawn all of our capital. So we start off with $100,000 in each trading scenario. So that's our baseline 100,000, and it's used up 100,000, and that is only 48%. So even though we've generated 103,000 versus 21, program 2 is also drawn the drawdown as 216,000. So that's a pretty big deep pocket you need there, hence the very low drawdown percentage. Program 3 has 171%. It's a bit lower than program 1. Program 1 being 189. So program 3 again uses our CCI, but it doesn't rely on touching the zero line for the moving average 14 of the CCI. And program 4 has 145%. And that's using the Heiken Ashi again with those entry and exit and average down approaches. And again, you can see there the profitability over the drawdown, and I'll show you the benefits and pros and cons of using program 1 versus, say, which is the next closest, is program 3 or 4. Okay, again, feel free to pause the videos on those charts and digest that. Let me get stuck into the price chart of the CBA Bank. I'll just show you the one example. This is the profitability. This is the price chart down here. And this is the profitability of that of those trades. So it's generated $24.92 as shown back here, $24.92 of revenue since 2007. So you can see here, we started the timeline back in 2007. These were all single trades. The only time it averaged down was during these years. We bought one set of shares there. We bought another set. That's where it averaged down once. So, and all the rest were singular, not averaging down trades. So it's generated $24.92. I'll talk about this one here. This is the Heiken Ashi, where it's done multiple entries. And let me just blow up this when it's entered these So each one of these steps, you've invested $2,000 worth of shares. In other words, you've entered down there with $2,000, you've added another $2,000 there, another $2,000 there. So there you've had $2,000, $4,000, $6,000 invested so far. I'm not going to count all those stairs. We can see there it's roughly 30 odd steps. So 30 times 2,000, you've invested roughly $60,000 if that is 30 steps in that period there between late 2007 and middle of 2009 where it closed out. Now, if you've got deep enough pockets to invest in that period, you would have started off back there. If you look at that profitability line, I'll just move the cursor there. From a baseline of 100,000, you got $718, and you closed out there with 9,300. So you've made about 9,000, or just under $9,000 in trades during that period, but you would have needed deep enough pockets to invest your money. Whereas here, you've only, if I blow this one up, in that period, very similar period, you've only invested one lot of $2,000 to buy 48 shares. So that's it. So you've invested $2,000. Here you've doubled up. You've invested $2,000 there and another $2,000 there. That's what those steps represent. So again, minimal averaging down, but in terms of percentage-wise, it's given you 236% versus the average, the drawdown requirement, and that, on average, it's 189%. Now let's look at very briefly program 2 for Telefonica. So let's that was and these are the other two programs for CBA. Let's look at Telefonica as an example, and to be cautious of how you use the average down. So again, let's look at our program. Let's maximize the investments made. So here you've invested once, one lot of shares at $2,000. It's another lot. So they're all single lots. Here you've averaged down once, twice. So you've invested 4,000 there. And here Telefonica has gone down since 2015. So you invested 1, 2, 3, 4, 5, 6, 7 lots. 7 twos are 14. So you've invested $14,000 since 2015 in Telefonica. But if you look at the profitability chart, yes, it's dropped below our 100,000 baseline. It's also coming towards the break-even point again. It's now sitting at 99,123. So it's coming towards our break-even point, even though we've invested 14,000 and the price chart is still going down. Whereas, if you look at this program here, it did quite nicely with multiple contracts entered along the way versus our program. Let me show you this. Right, you can see there each of those steps. There's quite a number of steps there, this being the biggest one since 2017. I'm not going to count all those steps, but you can see there, ballparking it, you've got at least 50 steps there. So 50 times 2, you've got over $100,000 invested in that. But what it's done, it's eaten up all your, if we had $100,000 as a baseline, we've used up all that $100,000 just on the shares, even though so the profitability hasn't made any impact. Now, if we had more money invested in that, we could have kept it going. Let's see what that's done. So let's change that program. Let's make that 150,000 as our baseline. You can see there it's coming back towards break even again. So if you had 150,000 as our baseline, it's bottomed out, similar to our program here, and it's coming back. So again, just make sure if you're going to be investing and averaging down multiple times, such as in this example or even this example, you have deep enough pockets. This wasn't as bad. This program wasn't as bad. Program 4, you can see here, program 2 was the biggest loser. Program 4 was considered to be third place with 145%. And Telefonica, from 100,000 baseline, generated $46,000 in revenue with a drawdown of $47,000. So again, feel free to freeze each of these, the video, and digest these programs and see where the entry and exits are. But I'm just emphasizing it's better to have a high revenue over a lower drawdown to give you a higher percentage of profit over drawdown to be effective when you're averaging down. Okay. So again, thanks for watching. Feel free to subscribe, hit the notification bell, and like the video to support the channel. Thanks, and see you guys next week.